I think it would be naive to think, okay, the Fed will now step in, they will lower rates, they will do some QE, and everything is going to be fine. For me, the big question, Patrick, is are we going to enter a recession or a depression?
Please join us for our next live stream Sunday, March 29 at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, March 29, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, if you are new to the channel or you have not already done so, please do subscribe. Click on the bell to be notified of new updates and give us a thumbs up. If you like what we do, we really do appreciate your support. Today, we have with us a return guest, Ronald Stoffele, a managing partner of Incrementum AG, an independent investment and asset management company based in Liechtenstein. A proponent of Austrian economics, Ronald co-authors the well-known In Gold We Trust report with Mark Valek, which has become one of the benchmark publications on gold, money, and inflation. And we're delighted to have him here today as a return guest. Good day, Ronald, and welcome back to SBTV. How are you doing?
Hi, Patrick.
Hey.
Yeah, it is, of course, quite turbulent out there. So many things happened just in the last 24 hours. And of course, as a fund manager, as a citizen, but also as a father of 3 kids, it's very demanding, it's challenging, and actually we're probably making history in those moments. So I'm keeping my diary, I'm writing down what's going on, because there's so much going on, and I think this is something that we will probably explain or tell our kids and our grandchildren at some point.
Yeah, you know, that's a good point. I mean, I've never thought about that, where I should be writing it down in a diary, trying to recall these things. But on the flip side, I will bet you the Fed is trying to forget everything that's happening right now. But Ronnie, 0%. Here we go again. What's your take on this, on the 0% this time around compared to 0% about a decade ago? What are the similarities with that 0%, and how does it compare to this 0%?
Well, we kind of wrote a whole book about that. It's called The Zero Rate Trap, in German, Die Nullzinsfalle, where we explained that central banks are basically out of bullets. Yeah. So the conventional tools that central bankers have, they're running out of them. And I wouldn't have expected it to happen that quickly, but we always said as soon as the US enters a recession, normally they lower rates by 500 basis points. Yeah. Yeah. So we've been at 225 a couple of days ago. Now we're at 0. In most of the other areas, especially over here in the Eurozone, we're already in negative territory. So we have to be certain that for this crisis that is completely different to 2008, because it's not coming from the banking system, not from the financial system, but from the real economy, that the tools will be different. So what we've seen tonight, actually, central banks, especially the Federal Reserve, they crossed the Maginot line. So now we're really in a new ball game. They've lowered by 100 basis points. Okay, that's like very conventional central banking. They reduced reserve requirements. So the reserve requirement ratio is at 0%. So that's basically, it means that there's no limit to credit creation anymore. They also expanded the dollar swap lines with other major central banks, like the Bank of Japan, the ECB, and I think the Swiss National Bank, to bolster dollar liquidity. There's an enormous rush for dollar liquidity at the moment. So I think that central banks, they are aware that they have to act more aggressively and more quickly, perhaps compared to 2008. But if we compare it to 2008, we should not forget that between summer of 2007 and winter 2009, there were actually 35 moves, 35 policy moves by the Federal Reserve. So it was not enough to stop the bear market and the recession from taking hold. So I think it would be naive to think, okay, the Fed will now step in, they will lower rates, they will do some QE, and everything is going to be fine. For me, the big question, Patrick, is, are we going to enter a recession or a depression? This will be determined by the size and the speed of monetary, but especially of fiscal policy. And let me be very, very clear. The problem is not the coronavirus. The problem is an extremely fragile market that is full of debt and leverage and that cannot absorb any shocks anymore. So it is really, Corona is only basically the catalyst for this driver, for this development. We have seen this the economy already in China being very weak in 2019. In the US, it was basically the stock market was already very narrow. We've seen that US companies were already in an earnings recession. We've seen that the yield curve inverted. We've seen that the Federal Reserve recession indicator basically put out a warning signal. So I think it's naive to say that it's just this coronavirus that is coming so unexpected. It's a real black swan that is pushing us into the recession. It is, as I've said before, the consequence of an extremely levered market that cannot absorb any shocks. And basically all market participants, we were conditioned like Pavlovian dogs. So every time the S&P is down 5 or 10%, okay, the Fed will step in. Yeah. That's over for now. Yeah. So I'm very, very concerned. I think it is very obvious that this crisis will be solved with even more interventionism and less capitalism. So yeah, we'll see how it's all gonna develop, but it's very, very challenging, but also pretty exciting.
Yeah, that was going to be my next question, where if the virus is the cause of this market meltdown, the repo market going full retard, and how we see a oil price war, in the works. That was my next question, where if we can blame all of this on the coronavirus, but you pretty much answered that. But you mentioned deflation. With all the money that's going to be thrown around, why not inflation?
Well, in our highly levered system, we should not always just blame the central bankers. Yeah, most of the money that is created is produced in the commercial banking system. So we should not forget what is the reaction for business owners in that environment. Of course, I mean, over here, everything is basically shut down. So I cannot believe why there are still some mainstream economists saying, okay, we're not sure if we're gonna enter a recession or not. Of course, it will massively impact businesses because this is just a huge contraction basically from one day to another. So what will business owners do? Of course, they will try to get to get liquidity. They will delay risky projects. Yeah. So I think we have not seen any consequences on illiquid investment markets like venture capital, like real estate, like the art market yet. But this is going to happen because, of course, the consequence of not only business owners, but also, of course, risk managers in banks and also consumers is, okay, we'll delay our consumption. Yeah, we'll delay all big projects. And this is very, very much deflationary. And we should also not forget that this deflation in asset markets, I mean, I don't know the number, but how many trillion have been destroyed in equity markets? they just evaporated in the last couple of weeks. This is highly deflationary. So I think it is pretty obvious that the end game will not be deflation, but a currency reform or high inflation. But at the moment, this is a very, very deflationary environment. And of course, in our system, deflation cannot be tolerated. And this is the reason why central bankers and politicians are so nervous at the moment. Our inflation indicator switched to deflation a couple of weeks ago. So we sold all our commodity positions. We sold commodity currencies like the Australian dollar, like the Canadian dollar, and so on. Of course, we didn't expect it to be such a dramatic deflationary move. Yeah. But again, we should not forget that all those measures that are taken now and that will be taken in the next couple of weeks, they will have a time lag. Yeah, a friend of mine, he compared it to drinking tequila shots. It's quite a while ago since my times when I studied and did shots occasionally. But you know, after 2 or 3, you feel perfect. Yeah, and then you say, okay, let's get another round. Let's get another round. And with a time lag of let's say 1 or 2 hours, then of course you see the consequences of doing all those shots, and you basically collapse or whatever you're gonna do. And I think, you know, there are quite a lot of similarities, because now they're so eager to kind of stabilize the system that there will be more and more measures taken, and they at some point they will have positive consequences, but with a huge time lag. So I think at the moment it is clearly a deflationary move, but on the longer term horizon, this is something that could end up, of course, in a currency reform. But I see inflation on the horizon as one of the biggest risks.
Okay. Yeah, you know, you've mentioned the currency reform twice, and I think Trump, he came out and said something along the lines of refinancing the debt. But currency reform, how would you define currency reform? What are you seeing as far as currency reform? Would that be central bank digital currencies, or are you seeing something else?
Well, that's a hard one to guess. I think at the moment, as I've said, there's an urgent need for US dollars in the system. Yeah? So if you understand the euro dollar system, it is clear that now with all those swap lines, this is really what the market needs. But let's look into the future. You know, the Fed stepped in with I think 1.5 trillion in liquidity last week, and it's going to be 500 billion per week after. Those are wild numbers. They announced the QE. I don't know if it's QE, if they're going to call it QE, or if they come up with another fancy name. But all those measures, they don't work. So last week the market perked up for 20 minutes, and then it went to morning lows right away. So the credibility of the Federal Reserve and central bankers is really shattered at the moment, and it's all about the confidence issue. Trust is highly asymmetrical. So our last In Gold We Trust report, May 2019, was about this erosion in trust. And from my point of view, it is, as I've said, it's highly asymmetrical. So if you've got a husband or a wife, and you're married for 30 years, and then you come home a bit earlier and see her perhaps with the neighbor or somebody else in bed, of course, all this trust that you've built, that you've created over 30 years, is gone in just 1 second. Yeah, and it's very, very similar with central banking and with currencies. So from my point of view, it is impossible to forecast when trust will be finally broken. But I think that the market showed us the last couple of days that they don't believe that the Federal Reserve will manage that. They know that the emperor has no clothes. So at some point, for me, I cannot rule out, first of all, that they will shut down markets. I think this is something that is becoming clearer and clearer. The second thing is, I think at some point they will change the Federal Reserve Act. It has been amended already 4 times in history. So Rosengren out of the Fed Boston, he suggested already a couple of days ago that the Fed should be allowed to buy a broader range of assets like stocks and corporate bonds. So this is something that will be used going forward. Will it be enough? I'm not sure. And if this, let's say, economical and financial crisis will become a currency crisis, a crisis of confidence in our fiat money system, then I think it's inevitable that at some point there will be a currency reform. Because those crises, as politicians always say, never waste a crisis. Those are, of course, the triggers for such, let's say, reallocations of the monetary system. And now, Patrick, we should ask ourselves, why does the Federal Reserve or the US Treasury own 8,100 tons of gold? The Euro system owns more than 10,000 tons of gold. China is buying every ounce they can get. Russia is buying every ounce they can get. So I think in the reallocation of our currency of our currency system, gold will play a major role. This is really a very, very high conviction that I have.
Okay. Since we're on the topic of gold, I'm constantly hearing from some viewers lamenting on gold's performance when prices fall. And I've seen you share some charts on gold's performance in multiple currencies. Can you share with us how gold has performed in, let's say, the last 2 decades?
Well, in the last 2 decades, of course, since 2000, it was one of the best performing asset classes, or definitely the best performing currency that we have. Yeah. And we have crunched the numbers, as you know, in Gold Ridge Trust reports. We're very much data driven. We really want to educate people about gold and what it does to your portfolio. That you shouldn't own 100% in gold, in silver, and in mining stocks, but it is a perfect portfolio diversifier. And of course, it depends on your age, on your asset allocation, and so on. But at least 5, 10, 15% should be in your portfolio as an insurance, or as Grant Williams says, gold is the ultimate insurance, because the more unsure you are about the future, the more gold you should probably own. Now, when it comes to performance, I think people got very, very greedy recently. Gold was up 19% in dollar terms last year. It was up, for example, in euro terms, 22%. Now, since the beginning of the year, it is basically flat in dollar terms, but it is up, for example, 14% in Australian dollar terms. It is up 8% in British pound terms. So I think gold did his job as a stabilizer pretty well, but we should not forget, and this is also the analogy to 2008, that in those times of financial stress in the markets, market participants that are heavy levered, that are mostly buying paper gold, they have to sell everything they have. So they also liquidate their gold positions. So for me, it is not really something that worries me a lot. Of course, gold can still go lower. The fact that it's up only 1% today after this huge announcement by the Federal Reserve lowering 100 basis points is a sign that there's still selling pressure. But that's, for me, that's totally fine, because gold will react to all those measures that are taken at the moment and that will be taken. Compare it to 2008, gold, but also mining stocks made the bottom basically first, while the broader market made its bottom in spring, I think late March, early April, when the S&P finally bottomed. So I think there's lots of similarities. From my point of view, the commitment of traders report was already quite worrisome. We've seen huge liquidation in Friday's commitment of traders report, although this is only until Tuesday. So I expect much more liquidation to be seen in the next commitment of traders report. And therefore, I think, yeah, gold is doing its job, but we shouldn't be too greedy. We shouldn't expect gold to skyrocket to 3,000, because I know many people who desperately need liquidity now. And this is not the big financial guys. This is people that really have a hard time making ends meet. They have to pay their mortgages. Yeah. They are perhaps losing their jobs. They have to buy grocery. So those people have to sell whatever they get a good price for, whatever is liquid, and gold, as you know, is highly liquid. So can gold go lower in the next couple of weeks? Of course. It might be one of the biggest buying opportunities ever, because, as I've said, those measures that are taken and that will be taken are huge, and gold will be one of the biggest beneficiaries.
Okay. Let's just hope there's still enough gold supply around if those prices do come down a bit. But Ronnie, what do you mean when you say that gold is the seventh sense of financial markets?
Well, that was a presentation, a keynote that I delivered at various conferences last fall, and I said that, you know, gold for me as an analyst is something that fascinates me, that amazes me every day, and I often ask myself, how can I write another In Gold We Trust report this year, because we already wrote 3,000 pages of research about gold, and every year there's so many new topics to write about that it's just fascinating. And gold, this is really important to understand. It is about everything. It is about interest rates, of course. It's about opportunity costs, like the bond markets, like equity markets, like real estate markets. But it's also about history, about monetary history. It is about religion. I think it's no coincidence that gold actually is something special in every religion. You can go to a church, you can go to a mosque, you can go to a temple. You see gold all over. So this is something that really fascinates me, and I think the fact that gold is basically something special in every culture, in every society, in every religion, also tells us that gold is discounting quite a lot of information from all over the globe. So we said that gold is the seventh sense of financial markets because it discounts future recessions, for example. It discounts monetary policy. It discounts developments in equity markets and so on. So we said last year, the sign that gold is rising now in every currency, also in US dollar terms, where we've seen this massive breakout last year, is a sign that there is something big going on. Yeah. And I don't think that gold basically sniffed out that it's going to be the coronavirus. But it was obvious last year already that the economy is not doing so well, that there's huge recession risks that nobody is seeing. Actually, I love this chart that we put out also in our last chart book, where we have a look at the analyst forecasts by the most important economists that are questioned by Bloomberg. So 87 analysts, really smart people with PhDs from Ivy League schools. How many did see a recession for 2020 or 2021? Zero, like in 2008. So it was a very, very high conviction that we wouldn't see any recession. And I think gold was already telling us recession risks are significantly higher than discounted by the market. And why is a recession a perfect environment for gold? Because gold discounts that there will be monetary stimulus and fiscal stimulus, that we're gonna massively increase our debt burdens. So this is what prepares a great environment for gold. And I think that gold was kind of discounting this already last year.
Yeah. Ronnie, why do you think central banks, why do you think they just simply cannot, will not, by all means necessary, let a recession happen?
First of all, I think they highly believe in their models. We should not forget that most PhDs in economics are employed by the Federal Reserve System. And of course, those are smart people, and they've got very, very complex models, very sophisticated models. The problem is those models, they don't work when the black swan arrives, like at the moment. So I think that, how should I put it? I think that central bankers have got this illusion that they are in control. Yeah. So I as a father sometimes have the illusion that my kids will do what I tell them. Yeah. We know how it then happens. Yeah. So I think this illusion of power to control markets and all market participants. Yeah, this creates, of course, high confidence in those central bankers, and I think it's if we just follow the last couple of years, I mean, we can already say that we've seen clear signs that this is not a healthy market, because basically it was all about in investing. It was all about discounting and anticipating what the Federal Reserve, what the ECB will do next. Yeah, are they going to lower by 25 basis points or not? Will they announce some new programs or not? This already tells you that this market is not dependent on entrepreneurship, on businesses, on good products, on creativity, innovation, but most importantly on central banking action. Yeah. And I think, I'm not sure if they will be able to reflate the bubble again, but it is obvious the bigger the bubble, the less it takes, or the smaller the needle has to be to pop that bubble. And if they should be able to reinflate the system again, which I'm absolutely not sure about, then of course they have to take much more dramatic actions. The Federal Reserve will, as I've said before, have to buy more assets. Like, Bank of Japan is running, I don't know, the 11th or 12th round of quantitative easing. They're basically buying everything they can get. Perhaps it's going the same way also in the US, but then the next step will be much more financial repression, will be capital controls. So what bugs me and what concerns me is that nobody is considering a market solution for the problems. So there will be more interventionism, there will be less capitalism, and this will, over the longer term, will of course weaken the whole system.
Yeah, it's pretty frightening to think about capital controls. But Ronnie, with what's going on right now, will this change? Do you think it'll change the psyche of people to put their faith in physical gold again?
Yeah, I mean, over here it's pretty obvious. I'm getting calls from people that haven't called me in ages, and they say, hi, how are you doing? What happened the last 10 years? I am considering buying gold now, and I say, okay, it's perhaps a bit late, but it's probably not the worst idea to consider buying gold again. I think that, as I've said, it's a confidence game, and people they intuitively understand gold if they have got it in their hands. And for me, there is no question that, if you ask yourself, will the purchasing power of an ounce of gold in 1, 3, 5, 10 years be higher than the purchasing power of a US dollar, of a euro? I think the answer is pretty clear from my point of view. But I think we should not forget that this whole environment that we're in and the environment that we will be moving into is something that is completely new for most market participants. We should not forget the average investment advisor in financial markets is 52 years old. So they were born in 1968. They experienced the stagflation of the 70s, but only as kids or teenagers. So if something like stagflation, which nobody is talking about at the moment, if this will be something that's gonna develop, then I think there will be a really big rush into gold. And for us, I think the most important thing is to make a solid case for gold, to not create any fear, but say, okay, let's crunch the numbers, let's compare it to historical times, like the 70s, for example, but also currency crises all over the globe, monetary reforms. What did gold do to your personal wealth, to your asset allocation, whatever? This is really important, and this is what we've done the last couple of years in Gold We Trust reports. And the answer is crystal clear. Gold is a very, very good hedge in times of falling real interest rates, in times of very weak stock markets, in times of very high volatility, in times of a weak US dollar. And if the market is expecting major experiments coming out of the central banks, so I think it's clear that the debt situation will not be solved by deflation. They will try to reflate it. I don't know what the fiscal side, the fiscal consequences will be, but we should not forget the US was already running $1 trillion deficit before the whole virus hit. So now, of course, GDP will collapse and they will have to do much more fiscal stimulus. So deficits will explode. And therefore, I don't see any way why this shouldn't be a positive environment for gold over the next couple of years.
Okay. Last two questions before you head out. What's going on with silver? The ratio is at or near all-time highs, over 100.
Yeah. A friend of mine said last week, I think, I've put in a huge buy order for silver at 14. And I said, 14? Okay, that's pretty aggressive. And, silver was down almost 10% just on Friday. It is something, gold-silver ratio, I think it hit 110 last week. It is really, really crazy. And the main reason, of course, is that silver also has lots of industrial demand. Yeah. While gold industrial demand is roughly 10%, so it doesn't really affect prices. We could see that silver was selling off with most commodities. Just have a look at the oil chart, for example, which will, from my point of view, this is only, the consequences of the whole crash that we cannot see yet, but the consequences for corporate credit due to oil markets going down basically 50% in only a couple of days. The consequences for the whole shale oil industry, for example, is something that the market is not discounting yet. We are seeing 640 trillion OTC notional derivatives. We're seeing 26 trillion just in FX swaps, and with this huge volatility that we've seen over the last couple of weeks, there will be further problems. They haven't appeared yet, but I can tell you that over the weekend, risk managers, asset liability managers, compliance guys in the banks, they were working basically the whole weekend, and they've got no clue how it's all gonna develop. But coming back to silver, I think we should not forget that if you really have a long-term view, I have to quote Howard Marks, one of the best fund managers out there. He always says, all great investments begin in discomfort. And if you say, okay, I'm buying silver now, you probably have got great discomfort. But every bottom will occur only prior to any good news. So probably the time when it's really darkest, it will be the time to buy. Are we able to time the bottom? No way. The only thing is that you can do as a prudent investor is you can say, okay, I'll buy 1/3 now, 1/3 in whatever 2 weeks, and 1/3 in 2 months, whatever. But nobody will really be able to pick the bottom. Is silver? Just have a look at the gold-silver ratio. In 2008, it rose up to I think almost 90, and then it went down basically straight, down to 45, something like that. So silver was a major outperformer of gold. So I think something similar might happen in the next couple of weeks. So if you're really bold, if you can deal with this discomfort, perhaps silver is not the worst idea. And also mining stocks. I mean, this was just, mining stocks were down just 32% just last week, 32%. We should not forget that the current gold price is $120 higher than the 2019 average. And on the other hand, oil prices collapsed. So oil is basically relevant for 54% of all input costs for the miners. So the margins of the gold miners, they're doing really, really well. Yeah. So there's this huge gap between actually profitability going higher and stock prices collapsing. So going forward, I think that's a pretty nice setup.
Okay. Well, in that, you answered my last question where I was going to bring up oil prices, so-called oil war right now, where oil prices are going down and what will be the consequence. And you measured, or you mentioned that we're going to have to start watching credit.
Yes. And I think, we wrote about the BBB sector in the US. So it's the most, let's say the most chunk corporate credit market in history of the United States. It's not only in the US, it's also over here in Europe and probably in Asia. So I think the bubble this time will probably affect the economy most, or the financial markets most, coming out of the corporate sector. But we haven't seen any downgrades yet. I mean, everything is so turbulent and volatile. We will see massive downgrades in the next couple of weeks. So many bonds will be downgraded to junk. And then the problem is, as the market is mainly passive in many areas nowadays, there will be no buyers. There will be no bids for those bonds. So this is really something that worries me for the next couple of weeks. And I don't see any possibility how they can quickly solve those problems. Of course, if the Fed should buy stocks, but also corporate credit, this will have an effect. But I think it would be naive to think, okay, the Federal Reserve and governments are going to rescue us right away, and in 2 weeks everything is going to be fine. It will take weeks, months, and probably quarters to really see the whole size of the problems and the second and third layer effects of what is going on now at the moment. So as we always say, have faith, but also buy gold. I think it's going to be very, very interesting. As a professional, I say, okay, we've got to make the best out of it. Those are the moments when you really learn a lot. This is something that is really career defining, but it's also not only as business owners, but also, of course, as citizens and family fathers, it is something that everybody should be concerned of and should really try to make the best out of it.
Okay, Ronald, before we wrap up, can you let our listeners know more about the In Gold We Trust report?
Of course, Patrick, we're already working basically 24/7 on it. We're a team of 15 people. The next In Gold We Trust report will be published on 27th of May. So we will not postpone it. It is really important to get the word out there, to inform our readers what's going on in the gold market, but also on a macro level. We just published a chart book on gold, which is some sort of a preview chart book. And yeah, you can sign up for our In Gold We Trust report on our webpage, ingoldwetrust.report. It is available for free, and it is probably one of or the most widely followed publication on gold. We had roughly 2 million readers last year, and we're already very excited about the next report because there are so many topics to write about. It will be quite tough the next couple of weeks because we want, every year we write the report, we say, okay, this should be the best gold report ever. This is what we are aiming for. And I think that's our hope that we're going to deliver again. But it's lots of work, capital, and devotion that is going into this report. And I hope and I know that our readers can really feel how much thinking and how much love actually goes into this report.
Oh, we feel it. We feel it, Ronnie. And I can tell you, after following it for a few years, it is the best ever. The next year and the next year and the next year. It's always the best ever. But you know,
Thanks.
Ronnie, it is. It's the greatest one out there, greatest publication out there for gold, especially. Ronnie, we do thank you for your time, and we do wish you the best with what's going on with the virus and the economy and everything else. And just stay the course. Stay the course.
Thank you very much, Patrick. All the best to you, the whole company, and all your listeners, readers, clients, and yeah, take care.
That was Ronald Storfley from Incrementum AG and the author of the In Gold We Trust report. For more of his insights on precious metals and the global economy, please visit his website, www.incrementum.li. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.